All right, good afternoon then, folks. We are at the end of another week of trading on Friday, the 22nd of March, end of an extremely busy week of trading. Now, we'll cover all the central banks, the Bank of Japan, the RBA, the Fed, the Bank of England, and the Swiss National Bank. Bit of action across most of these decisions towards, or as and when they came out over the course of the last few days. But if you have a look back to the video on Monday, we had a look on Monday at these central banks. We actually managed to get a few of them right. Bank of Japan we managed to get right, RBA we managed to get right, Bank of England we managed to get right. Fed, although we got the Fed a little bit wrong. I disagree with the Fed entirely, but that's my view. I ain't no central banker, so I'm not gonna go on too much of a rant on this video. Dig on a little bit to our students the other day, but that's what it is, I suppose. Again, I would hope they know better than me. Sometimes I really question it. Bank of Japan, though, Monday night, Tuesday morning, exited negative interest rates and removed yield curve control. Now, that is a hawkish step from the Bank of Japan, the most hawkish step they've made in a near decade or over a decade. I think 2007, if I remember right, was the last interest rate hike. So yeah, I mean, certainly not a situation you get, or certainly not a saying you've heard a lot over the last number of years. The Central Bank of Japan raising interest rates, so you'd expect that to be a bit of a hawkish step, but they communicate these things well to markets well ahead of time. Markets knew they were going to exit negative interest rates. Markets knew they were going to end yield curve control. Then the analysis turns into what to look for past that. A lack of any sort of forward guidance on what we're going to get past that. No clarifications on whether we will get more interest rate hikes or not. And the market kind of took that as a bit of a dovish step. They'll price these things in ahead of time. And also ultimately, you got to look at the differential between yields. I mean, if interest rates aren't going to rise any further, yields aren't really going to rise with it. They don't exactly have strong growth. They don't exactly have stellar economic numbers to push these yields higher in that respect. So a lack of commentary on they are going to hike interest rates again is dovish then, right? Exiting negative interest rates, hawkish, removal of yield curve control, hawkish, but nothing past that means yields don't have a chance to catch up to the rest of the world. Keeps making or continues to make the Japanese yen less of an attractive proposition for investors worldwide. So the carry trade remains on the Japanese yen. Interest rates are still much lower than the rest of the world. Ultimately, if we don't get a series of hikes from the Bank of Japan, it fails to really change much in terms of strength behind the Japanese yen. That was pretty, I don't want to say easy, but it was tellable from earlier on in the week. The RBA then kind of dropped forward guidance that they are prepared to hike more. Again, that's what we looked at. We look for them to drop that section of their statement, and now said that they are prepared to go either way, which is a step towards the dovish side, and dovish central bank currency sold off the back of that. Then into the Fed on Wednesday. Our analysis into the Fed on Wednesday was looking back to last year and the dot plot indicating 3 interest rate cuts over the course of 2024. Right, there was potential for them to go and then change that. The reason why they would go and change that is because stellar economic numbers, economic data out of the US has been good over the last number of months. Contrary to what some people think about the state of the global economy at the minute. US numbers pretty good. You then look back to inflation of last week, CPI higher than anticipated. You then look at PPI much higher than anticipated. Both of those are contributing. Both of those are they are the inflation numbers. You then get commodities, which are a contributing factor to inflation. They are up at 2023 highs. Which is kind of bar the Russia and Ukraine situation kicking off, those post-COVID highs, and they continue to rise. Prices of oil continue to rise. They are all contributing factors to inflation, and that should potentially or may potentially continue to put upwards pressure on inflation. You then look to the central bank, which is what I just don't get it. I mean, they seem preset on their path and they stick to their path, but they made a mess of monetary policy in 2020, 2021. Then made a mess of it again, hiking interest rates too late. Are they going to make a mess of it again? I mean, they have kind of a history over the last few years of, they pick a path they're going to go down and they stick on that path. There is no flexibility. There is no change from that. They pick a direction, they go in that direction. And if it proves to be wrong, they kind of are a bit arrogant and don't admit defeat, right? you look at the Fed, they upgraded economic projections, or you have updated economic projections, but they upgraded projections to growth, they upgraded projections to inflation, they downgraded projections for the unemployment, for unemployment rate, right? You then look at them upgrading projections for interest rate through to the end of the year 2025 and 2026. So I'd expect interest rates to be higher in a couple of years and next year and a couple of years than they were back in December. They expect growth and inflation and the labor market to all be stronger than what they did in December. Right, you get inflation re-accelerating, you get commodities rising higher, yet they're still sticking to the script of we're going to cut interest rates 3 times. No chance. There's no chance they're cutting interest rates 3 times, in my opinion. When they backtrack on that is another question, right? Markets certainly equity markets took that as a bit of a green light ahead. We're going to get the 3 interest rate cuts, but it's not cutting interest rates when you got inflation accelerating again. It's just stupidity. I mean, they've done a number of stupid things, as I said, over the past few years. Is this one more? It's difficult one to sort of wrap your head around, but it's kind of what I'm thinking at the minute. Right? It's like interest rates being cut 3 times. If inflation continues to accelerate, it's just not going to happen. Right? They're not going to cut interest rates in May. That brings us forward into June, where there's a 70% chance of an interest rate cut. If you get one more hot inflation print, all that has to be priced out of June. One more hot inflation print, you're not getting any interest rate cut in June. Then that leaves you 4 meetings for the rest of the year. They're going to cut 3 times in those 4 meetings. I just can't see it happening, me personally. Unless things drastically change with the economic data and inflation takes a nosedive, I just can't see it. Can't see it happening unless. I mean, you can be a bit cynical and think Jerome Powell wants to keep his job when Donald Trump rocks, if Donald Trump rocks up in November of this year. I mean, I don't know. It's a bit. I mean, you can't really play with the economy like that just to keep your job, can you? But the other way you can view it is he prepared, or are the Fed prepared to allow inflation to run hot, allow it to run above their target? If they're going to allow it to run above their target, I doubt they're going to cut interest rates anyway. They might want to cut them a little bit, and kind of front and run some cuts, but that runs the risk of acceleration, or of inflation accelerating again, and that's playing a risky game. No, that is playing a risky game, and that would all mean that yields need to reprice higher. And if yields need to reprice higher, that is essentially interest rates moving higher. Essentially interest rates moving higher, because a lot of things are based off around yields, namely the 10-year yield. So it's a difficult situation for us to sit here and predict. It just, I mean, I thought he had a job to do, Jerome Powell, on Wednesday, to come out and dampen expectations, right? To get inflation further down, to dampen expectations of the whole world is rosy, everything's going to be perfect. We're going to cut interest rates a bunch of times, inflation's going to come down, and we're going to have this perfect soft landing. Economics doesn't really work like that. You're going to have some sort of, thing you're going to have some sort of thing to go wrong. It can't all go perfectly when you go from 0 interest rates to 5.5. It's gone perfectly so far. But I'm not going to sit there and be like, short stocks, short stocks, short stocks. The bias is still tilted higher for them at the moment. The markets are still, on board with the kind of soft landing, 3 interest rates cuts this year. I do think there will come a time to sell equities. Not right now, though. Continue to buy them in the short term. Long term holds, I'm not so sure, but certainly in the interim, if you're trading intraday, or holding positions for a few days, maybe even up to a few weeks, probably still have a long bias. But I do think that changes at some point. US dollar, maybe it's a different situation. I kind of would be bullish on the US dollar from a personal point of view. But anyways, we'll talk more about that as we go on through the weeks ahead. On to then the Bank of England, right? The Bank of England inflation lower than consensus, lower than previous on Wednesday, as you can see. The Bank of England then came in and then said that you got the. If I just get back to this medium impact and come and look at the votes for cuts and votes for hikes and votes for it to be unchanged, the members of the Monetary Policy Committee went from 6 people voting for it to be unchanged up to 8 people voting for it to be unchanged. That is then the 2 hawks voting for a hike at the last meeting have now backtracked and are voting for it to be unchanged. No change to the interest rate cuts, but that suggests that the central bank is moving more towards interest rate cuts, or being more open, and that's all members being more open to interest rate cuts, even the hawks, which is a significant development, more than what markets then expected. Right? They then in their minutes suggested that they are moving towards the point of interest rate cuts, and interest rate cuts are on the agenda at some point later on this year. That's more dovish commentary than we have seen before from the Bank of England. Inflation continues to come down, nearly back under 3%, or it's a 3.4, but next inflation print hopefully gives us a bit more. And we'll start to have the discussion about when we get those cuts from the Bank of England, right? But we did get a cut, in fact, from the S&B, the Swiss National Bank, a surprise interest rate cut. You say a surprise, is it that much of a surprise? I mean, Simon Jordan, the boss man over at the Swiss National Bank, suggested at the World Economic Forum a number of weeks ago that the Swiss franc was slightly too high. They needed to do something in order to get the price of the Swiss franc lower. Inflation is back within their 2% target, right? 1.8% inflation print. Year over year, inflation has been below 2% for some time in Switzerland. They did not have to experience the high levels of inflation that other countries across the world did, whether interest rates are lower, albeit they did start from a minus 0.75%. Starting point as well. So the first of the G8 central banks to cut. Swiss franc sold off massively off the back of that, 100 pips on the release, 30 pips before that. Maybe some people know something that we didn't, but I mean, in hindsight, you could have predicted it ahead of time. You looked at it, we were talking on the trade floor before. It happened at 8:30. This is probably a likely scenario. Did end up panning out. Did get some aggressive price action off the back of it. So a raft of central banks out this week: RBA, dovish; Fed, dovish; Bank of England, dovish; S&B, dovish; Bank of Japan, I mean, technically hawkish with what they did, but in reaction to it, then dovish, which is all dovish central banks. The ECB, the Bank of Canada, all switching. The Bank of Canada maybe one bit of an outlier. I said, it's still a little bit premature to talk about interest rate cuts, but yeah, where you go with that? 8 dovish central banks across the board makes it difficult to trade. But you look at Aussie Euro, Aussie, Kiwi, Euro, and Sterling all pushing higher off the back of the Fed. All of those moves have now been reversed, and most of which extended past that. Right? Do markets wake up to the fact that the Fed are probably wrong again? I wouldn't say they are wrong. I say probably. I mean, it's just nonsense. I'm even get annoyed over this video even talking about it. But same thing with dollar Swiss, obviously with the Swiss National Bank, though. Dollar CAD, dollar yen, all these moves have been reversed post Fed. Equities managing to hold firm up top. I mean, it wouldn't surprise me at all if we did get sort of some profit-taking moves into the weekend, but yields pushing lower and the dollar pushing higher is not something you see too often. Maybe it's a bit of a safe haven playing the dollar. I'm not quite so sure, but what yields are doing at the minute, I don't really know, to be honest. Kind of a bit all over the place at the moment, but I mean, US dollar strength across the board certainly makes sense to me on a personal level. The rest of the currencies, I'm not going to go through each of them individually across the board. They have moved how I've said they've moved over the course of this video. So yeah, I mean, going forward, I mean, it's a dovish Fed. I don't think it's right. I think market participants, I mean the market's dumb at the best of times, but on a number of different things. But I would suggest probably US dollar longs don't seem a bad idea. I still stick to the script that I had on Monday. I don't say the market is dumb. Obviously, I'm a bit of an idiot from time to time as well. So, US dollars, I think being long US dollars isn't a bad idea with the way markets have reacted to sterling this week. Short cable, probably not a bad idea. Net longs in sterling are extremely high. That's a lot of positioning to be unwound. So if you're playing dollar strength, I think cable is not a bad idea. Dollar yen, I mean, you might look at dollar yen, but ultimately dollar yen's up at that intervention level of 152. So I'm not going to be wanting to buy that up there. Dollar Swiss may be a play as well. And I mean, selling the euro is never a bad idea over the course of history. So yeah, that's kind of where I'd focus my attention on. Probably cable. Dollar yen, you can have a look at that. Dollar Swiss, euro, maybe the Aussie as well. But I probably would stay away from the Aussie unless equities got going to the downside. If equities get going to the downside, the Aussie is your currency of choice after the central bank this week. We won't look towards next week today. We'll cross that bridge when we get to it on Monday. We'll have an update on what we think on a shortened week. Certainly in the UK, we've got Good Friday next Friday, and we got Easter Monday the following Monday. So 2 4-day weeks for us. Us here in the UK. Bull update more next week when we get around to it. So a massive week of central bank announcements. that's a bit of an attempt to break them down in 10 or 15 minutes. Hopefully that made sense. Any questions, feel free to ask.